If you're looking for income you can actually live on, you're probably already exploring the YieldMax ETFs. Specifically, two of the most talked about high-yield plays right now, ULTI and MSTY. These ETFs aren't your grandma's boring dividend funds. We're talking about ETFs designed to squeeze income out of volatility, with annual yields that can touch 70–80%. But, while they may look similar on the surface, ULTI and MSTY couldn't be more different under the hood. So the question today isn't just which one pays more, it's which one fits your risk tolerance. Which one belongs in a portfolio designed to sustain income over time? And is there a strategy where you could, or maybe should, own both? Let's dig in, break it all down, and help you make sense of one of the most exciting new ETF matchups in the high-yield world. What are ULTI and MSTY really? Let's start with the basics. MSTY, the Bitcoin proxy. MSTY is YieldMax's covered call ETF based entirely on MicroStrategy, MSTR. In case you're new to that name, MicroStrategy is a software company, but more importantly, it's become a proxy for Bitcoin. That's because their CEO, Michael Saylor, turned the company into a kind of corporate vault for Bitcoin holdings, and as Bitcoin rises or falls, so does MSTR. MSTY writes covered calls on MSTR, capturing the juicy premiums created by MSTR's explosive volatility. The result? Monster monthly payouts, sometimes as high as $4 per share, though more recently it's dropped to around $1 to $2 depending on volatility. ULTI. The diversified machine ULTI, meanwhile, is an actively managed fund. Instead of being tied to one ticker, it's built like a dynamic high-volatility portfolio. ULTI writes calls on a curated basket of hot, high-IV stocks. Its holdings include Tesla, Palantir, Reddit, Coinbase, TQQQ, leveraged NASDAQ ETF, Upstart, Supermicrocomputer, Robinhood, IonQ, and more. It's a mix of speculative growth names and high IV darlings, with the new addition of put options to help hedge against downside risk. So while MSTY is laser-focused on MSTR and Bitcoin, ULTI is a broader, more diversified engine designed to churn out consistent income. Let's talk about yield, because let's face it, that's what brought us all here. MSTY yield, at its peak, over $4 per share month recent average, $1 to $2 annualized. Around 72% depending on share price and IV ULTI yield. Now paid weekly average weekly payout, 8 cents to 11 cents annualized. Roughly 78.5% at recent share prices. At first glance, ULTI takes the edge. But this comes with a big asterisk. MSTY's yield is tied entirely to how volatile MSTR is, and that volatility has been dropping. So payouts are inconsistent. ULTI's diversified approach means you're less reliant on any single stock for your paycheck. That stability gives investors confidence to hold, or even scale, their position. Also worth noting, YieldMax added puts to ULTI's strategy. That reduces tail risk and gives investors some breathing room if the whole market pulls back. If you've watched MicroStrategy trade before, you already know. It moves like a roller coaster. Since it tracks one hyper-volatile stock, MSTY can swing double digits in a single day. That means huge upside, but also massive drawdowns. Case in point, MSTR is known to drop 30–50% in a correction, and when that happens, MSTY is right there with it. On top of that, the income shrinks when volatility fades, meaning you're not being paid as much during downturns. ULTI, by contrast, spreads its exposure across 10+ high IV stocks. While these are still aggressive names, they don't all move in the same direction. Plus, the addition of puts helps create a floor underperformance. Sure, you won't get a 100% pop like you might with MSTY in a bull run, but you also won't get your face ripped off if a single name crashes. Investors who want to park real capital, like $50K, $100K or more, feel safer doing so in ULTI. It's just better suited to larger allocations. Let's say MSTY gains 100% in a year, and ULTI gains just 15%. Sounds like a slam dunk for MSTY, right? Not so fast. What matters isn't just the percentage, it's how much money you were comfortable putting in. If you only put $5,000 into MSTY because it's too volatile, but put $50,000 into ULTI because it feels safer, you're still walking away with more dollars from ULTI. MSTY, 100% gain on $5,000 equals $5,000 ULTI. 15% gain on $50,000 equals $7,500. That's not even counting the dividends, which might be higher in ULTI due to more consistent payouts. So for many investors, ULTI is the better vehicle for real-world income, because you can scale it safely. Dividend trends. What's really happening? MSTY dividends over time. November 2023, $4/month. May 2024, $4 again. June July 2025, $1, $1.50. That's a major downtrend. Why? Because MSTR has been trading sideways, and sideways markets crush implied volatility. MSTY needs wild moves to stay juicy. When MSTR stalls out, MSTY's yield dries up. ULTI dividend stability. ULTI's new strategy seems to be working well. Weekly payouts of 8 cents 11 cents on a $6 ETF are insanely high on a yield basis. More importantly, these payouts are smoother than MSTY's big swings. Plus, ULTI's net asset value, NAV, has started to stabilize. We've seen a shift from price erosion to sideways movement, and even small uptrends. That's encouraging. For income-focused investors who want to live off distributions, ULTI is the more stable option. The reverse split debate. What if ULTI or MSTY reverse split? Here's the truth. It doesn't matter. Reverse splits are cosmetic. Your total dollar investment and yield remain the same. The only thing that changes is the number of shares you hold and the share price. In fact, reverse splits can lower your margin maintenance requirements. So don't fear the reverse split. It's a tool, not a red flag. 1 year performance, the shocking gap. According to Seeking Alpha, from mid-2024 to mid-2025, MSTY is up over 130%, ULTI is up around 15%, big difference. But remember, MSTY is leveraged Bitcoin exposure in disguise. If Bitcoin runs, MSTR runs. And when MSTR runs, MSTY flies. So you're getting higher upside, but you're also dealing with way more volatility, payout inconsistency, more drawdown risk. ULTI, by contrast, gave investors a smooth, lower-risk 15% gain, plus steady income. And if you have a bigger portfolio, ULTI may actually generate more dollars. Use both? Absolutely. Here's where things get interesting. Why not use both? Use ULTI as your foundation, diversified, high income, lower volatility. Use MSTY as your kicker, small allocation, big upside potential if Bitcoin explodes. This hybrid strategy lets you capture Bitcoin exposure, enjoy weekly income, hedge downside with ULTI's puts, diversify your income sources. Add in other YieldMax ETFs like ULTI, Palantir, NVDY, Nvidia, TSLI, Tesla, GUI, Google, and you can build a full income-generating machine. You might even consider hedging with something like YQQQ, a bearish ETF for the Nasdaq, if you're looking for downside protection. Final verdict. So, MSTY or ULTI? If you want to swing for the fences and you love Bitcoin, MSTY is your jam. But if you want to park capital and actually live off your portfolio in a sustainable way, ULTI is the clear winner. Personally, I hold both, but I allocate far more to ULTI. Because for me, it's about stability, predictability, real-world utility. ULTI's diversification, active management, and now its protective puts make it one of the most compelling income products on the market today. Your move. Now you've seen the breakdown, the data, the strategies, the risk profiles. So, what's your next move? Are you stacking ULTI for reliable, scalable income? Are you speculating with MSTI on the next Bitcoin breakout? Are you using both? Whatever you choose, make sure it fits your goals, your risk tolerance, and your lifestyle. And most importantly, don't chase the highest yield blindly. Understand where that income comes from. Know what's under the hood, because that's the difference between a short-term sugar rush and a portfolio you can retire on. If this deep dive helped, consider giving it a like, or better yet, check out our latest episode where we dissect the newest YieldMax funds. Stay smart, stay diversified, and as always, crush the market. Peace out.